Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. Our show today is brought to you by the C5 Plus CCIM Global Summit. This is an annual event, and yes, it is global. If you're in commercial real estate, this is the event of the year. This year, it is in Chicago. It's September 16th to September 18th. Check it out. Learn more at c5summit.real estate. All right, let's get into the show. One of the big topics that everyone likes to hear about these days is multifamily. One part of the multifamily are the build-to-rent subdivisions, which we're seeing more and more of. People are really interested in what's going on there. What's the exit strategy? How are these homes built? Where these projects go? How is it impacting regular housing? Let's find out. Please welcome my guest. It's Chris Finlay. Chris is founder and CEO of Middleburg Communities. Chris, thanks for being here in Studio One.
Oh, thanks for having me.
Yeah, good
to be here.
Thank you. Well, give us the 60-second view of what you guys do and how long you've been doing it.
Wow. Yeah. So we've been doing rental housing for a little over 20 years now. Just had our 20th anniversary last year. So been around the Southeast and into the Sun Belt doing everything from acquisitions, development, construction, management in that kind of rental housing sphere for that entire period of time.
Okay. So you've been doing multifamily, kind of normal, traditional multifamily, right? And then you've been doing some of the build to rent.
Yeah, the build-to-rent is an interesting product. You know, it's if you just think about housing in general and rental housing in particular, I think there's a few kind of misunderstandings. I mean, first of all, about 50% of all renters live in some form of single-family, townhouse, non-apartment type housing. And frankly, when we started researching BTR, we had no idea. We think that multifamily, like apartment buildings, are the center of all rental housing. In fact, it's only half of all rental housing. And the typical the typical renter that's or owner of single family houses that's renting these others it's mom and pops. I mean, it's still only 3 or 4% institutionalized on the single family side. So that was kind of the interesting opportunity there, is that sector becomes more institutionalized and more organized. And so, we started getting into that in about 2018 into the BTR space, and now it's become a fairly meaningful part of our business.
What's the size range, acreage-wise, of these communities?
So, look, we try to do a little bit larger. When I think about BTR, it is built to rent, or you call it BFR, built for rent, but it is purpose built for rentals. And that means it's amenitized, it's operated like an apartment community, meaning on-site staff 24/7 for work order support and emergency repairs. And it's all the maintenance, it's everything included like you'd get if you were renting an apartment. We tend to try to size them a little bit larger as a result. So kind of our smallest is about 210 units up to about 280 units. We generally size these around 8 to 10 units to the acre. So you're around a 30-ish acre site or more. So pretty significant.
How does the average size of these build-to-rent homes compare to the average size of new homes today?
Well, that's interesting. So I would say they're slightly smaller, but not as much smaller as you would think. And part of that is just driven by where we view demand. Within Middleburg, we're kind of very research oriented. And so before we even got into developing BTR communities, what we did is we started looking at what is the, where is the demand coming from and what is it that the consumer wants? And what we realized is, if you think about it, and just stepping back for a second, the whole idea of the single family rental from an institutional standpoint really became popular coming out of the great financial crisis, right? All these big institutional investors and, the Starwoods and the Blackstones and all these folks raised a bunch of money for distressed multifamily, which never really happened, not at the level that they had expected during that downturn. And they said, we can start buying foreclosed homes and we can start renting them out in mass. And that was really kind of the initial institutionalization of this kind of single family rental model. And from there, though, it has migrated, understanding the operational challenges of the scattered site single family rentals. But then it migrated into more of the home builder product, where home builders started saying, wow, got the infrastructure, I've got these lots already done. I'm I'm going to go build this back section of my master plan community, 100 units. I'm going to go ahead and build them. I'm going to rent them, and then we'll sell them as a SFR community. It's continued to migrate. What I think is interesting about the BTR space is that what we find is that the locational characteristics that really drive demand for this BTR are really not any different than multifamily, right? It's you want to be in high growth markets, you want to be close to employment, you want to have supportive services nearby, good transportation thoroughfares, good school districts. I mean, really all the things you're looking for a multifamily project, but it's more land and maybe from a zoning perspective, more likely that the community would rather have a BTR project than a multi-deal. That's really kind of our key determinant. If you think about what the renters can't get in the other 50% of the rental market right now, is they can't get a 2-bedroom cottage, right? So when we think about how we put these together, our focus is really about meeting demand. And that comes in, what does a consumer want and what can a consumer afford? And so in this case, what we try to do is we focus more on 2s. Our typical project is probably 70% 2 bedrooms, 25%, 25% 3 bedrooms, and then a few 1-bedroom towns or duplexes on top of that. And that really allows us to keep affordability within a spectrum that we think is responsive to what the consumer can afford in those markets. And then secondly, it's a product that can't really be satisfied in kind of the broader single family market. So when you do that size adjustment, I'm rambling a little bit here on this, but when you do all those size adjustments, that puts our average square footage around 1,400 square feet for an overall project, maybe a little bit bigger, depending on the exact unit mix. But we skew a little bit smaller. On a per unit size, our 2 bedrooms are 1,300 square feet for a typical cottage with no garage. It might go up a little bit more than that with garage. 3 bedrooms are going to push 1,500 to 1,700 square feet. So really not that different, but I would say a little bit smaller, a little more efficient, and designed specifically for renters, not for somebody who's looking to go buy a home.
Talk to us about the difference in, if there is a difference, in the demographics of the tenants that go in a build-to-rent subdivision like this versus apartment homes, and about the duration. Do they stay a little longer in these than a normal apartment dweller?
So, I'll hit that backwards. The average age is 4 or 5 years older on average for BTR than it is for our multi, based on our portfolio experience. Our really key determinant is staying within reasonable affordability bands. The strategy, and I digress for a minute. Our strategy isn't really different between multi and BTR, right? It's the idea is you go to high growth markets like in Atlanta or Charlotte or Raleigh or Nashville, and you go there because they're creating population, they're creating jobs. And then the idea is that, you want to be proximate to where those jobs are being created. I have the saying, people drive to own, people don't drive to rent. And I find that true of single family as well as multifamily. They may drive a little bit further, but think about it. I mean, people will commute an hour to go buy their first house in the suburbs, and because they're buying a house. People are not driving an hour to rent anything anywhere. It's so the idea is you have to stay proximate, and you have to stay proximate to those employment nodes. And then you have to be affordable to the jobs that are being created. And yes, because you're skewing a little bit older, you're able to pick up a slightly higher income renter, but we still stay, in terms of AMIs, we try to stay no more than about a 115 or 120% of median income, kind of size adjustment. And that's kind of where we find our sweet spot. Whereas multifamily, even our nicest multifamily, we try to stay right around 100% of median income rents.
How about how long these tenants are there? Do they tend to stay a little longer than apartments? We're selling a apartment complex, a Class A one, and some of the buyers are saying, well, a project across the street has higher rents and it's cheaper per unit. And I'm like, well, wait a minute, those are over half of those units are studios. And I've ran a property management company. Our studios turned over constantly to the little bit larger units that tend to stay a little longer.
So based on our experience right now, we're getting a little better retention rates. I think it's still early to tell, right? It's we'll see what happens over a longer time series here, but so far we're a little bit higher. I find it interesting. Look, rental retention rates are up fairly significantly already. I mean, what used to be a 45 to 50% retention annually is now 55 to 60%. And I would say that there's two reasons for that. One, it's look, the home ownership market is pretty difficult to enter today. Home prices are up, interest rates are up, so it's tough to buy a home. So affordability is tough. I think alternatives are better today, like the BTR product versus buying a home. So, people aren't feeling the pressure to move. So I think there's a couple dynamics there that'll continue to weigh in favor of longer retention rates there at the BTR for sure.
Yeah. One of the things that's on everyone's mind these days are the tariffs.
Yeah.
They were really scary at first, and that seems like maybe things are softening down a little bit. You're in the trenches. You're building out there right now. You're seeing how it's impacting your tenants and your development. What do you see right now?
It's funny because this is the question that everybody asks, right? I mean, tariffs, what's going to happen? So far, we've seen no impact of tariffs this year. I mean, it's interesting on the projects that we're buying out today. I mean, it's no different than what we priced them 3 or 4 months ago. Typically what we try to do on our construction side is we'll enter into a GMP contract to build the project, and we'll price it, and then we'll enter into our subcontracts within the next 90 or 120 days. And just within that period, on all these deals that we are pricing every day now, we're really seeing zero impact. And good. I think some of it is just that the subcontractors are absorbing some of that risk, frankly, just given the forward supply is dropping off and forward construction pipelines are being reduced. But so far we've seen very little of it. The other piece of that is that, look, there's still uncertainty, right? I mean, I think that's the biggest issue. It's not the stuff about; it's what you don't know that might be coming around the corner. And there's been tariffs before. It's amazing how resilient the supply chains are to migrate to different markets to optimize, what the effects of tariffs could be. But ultimately, we've seen very little. I mean, we quantified it like less than a 1 or 2% total impact overall to a project. So we have not seen anything that's really particularly concerning.
Well, that's good to hear. What about the labor side of construction? How's that going? And have you seen any impact from the immigration policies today?
Yeah, so that's another question that we get a lot. The short answer is no. Look, we're building $75 to $100 million projects. So, the labor pool that's on our sites are probably different than, a local home builder, and no disrespect there, but it's, we're not hiring people to build one, to frame one house. Sure. And so it's, just given the size of the subcontracts and what we're doing, we're really not dealing with illegal labor to begin with. But overall, again, haven't really seen an impact. Look, the whole immigration thing, I think, is a bit overblown anyway. I mean, all this idea of deportations, I mean, the fact of the matter is that there's been less deportations this year than under President Biden or President Obama. There's been almost no impact. It's not like there's broad-based deportation, and that's not a political statement. I mean, this is just kind of from a number standpoint. And so, we're really seeing no impact in labor shortages today.
What are you seeing for financing, construction or permanent financing today, and what trends are you seeing?
So another interesting question. Today, we're seeing a good amount of liquidity in the construction financing from banks. We saw, in the multifamily market, look, we've got the benefit of having Fannie, Freddie, HUD. Secondarily, you've got a really deep kind of debt fund and structured credit market out there. So there's a lot of liquidity. What we're seeing is a lot of construction loans being paid off with debt fund or bridge equity or bridge debt rather from different groups. And so that's freed up a lot of construction loan capacity from the regional and national banks. And so we're seeing a lot of liquidity there. Just over the last 6 months, we've seen leverage tick up maybe 5 points in terms of loan to cost. We've seen spreads on construction loans come down maybe 50 basis points. So we're starting to see some movement there. And more importantly, we're just getting multiples of term sheets, whereas a year ago, you go out and you're getting 1 or 2 term sheets. Now you're getting 9 term sheets, and so there's just a lot more demand there, and so we're seeing that's looking fairly positive. Yeah. Like I said, a lot of liquidity for on that bridge debt side. So if you're rolling off of a construction loan, you can get off a recourse, you can get off of kind of that short-term floater. You can plug in kind of that 3 to 5 year bridge loan very, very efficiently. Cost of funds there is pretty attractive. And then it gives you time to stabilize, let some of the supply wash through some of these markets, get your rents up, burn off concessions, and be a better position for Fannie and Freddie type financing, or sale for that matter.
Yeah, that's good to hear. As you're looking at forward performance expectations and you're performing your rents and occupancy, and you're obviously doing a new construction, so you're watching the new construction in all of these markets. Seems like in a lot of the markets we're seeing new supply really drop off. A lot of supply, a wave of it kind of hit in the multifamily world, and in some of these markets we're seeing it just really stopping. Do you consider that in your projections?
Absolutely. Yeah. Absolutely. Mm-hmm. Look, I hate to be the over optimistic developer, but it's hard not to be optimistic when you look at fundamentals today. And a lot of the discussion is on the supply side. Well, look at all the supply that's hit, Charlotte or Atlanta or Nashville, and this wave of supply, and everybody wants to talk about supply side. The reality is, what I think is so impressive is the demand side of the equation. Yeah. When you look at these high growth Southeastern markets in particular, they have really continued to outperform on the demand side of the equation. When you think about the amount of absorption that occurred last year and into this year, even, first quarter of this year had more absorption than any other period on record for a first quarter of the year. It was somewhere around 150,000 units of net positive absorption. So, and that has just continued into the second quarter. I think we're going to see another year of 600,000 to 700,000 units being absorbed. So the demand is there. And what's so fascinating is when you look at supply, to your point, I mean, supply is really kind of fallen off a cliff when we look at upcoming deliveries over the next 12 months, and starts are, just a fraction of where they were a year or two ago. So the forward fundamentals are pretty encouraging today. Yeah.
What would you leave our audience with to think about, Chris, related to multifamily moving forward and build to rent?
Wow. So, a couple things. So look, I think build to rent is a really fascinating, differentiated product, right? It's, I think coming out of COVID really kind of accelerated the transition to build to rent, made people realize that the value of their own front door and being able to have a grill out back. Every millennial I know has maybe it's not even millennials anymore. I'm so old, I can't keep track of all the different generations, but all the young people have a dog, right? So, having the ability to walk the dog and all of that. So I think the build to rent product really has legs, and we're seeing it. It performs. It will outperform multifamily in the same submarkets, even those submarkets that have a lot of supply. The build to rent is absorbing very quickly. So I think that's a subsector that has got a lot of legs, that I think we'll see a lot of continued differentiation. It's still being defined as an asset class, kind of a sub asset class. So I think that it will continue to mature. I think there will be continued differentiation between build to rent and single family rental. And so I think that'll be a really interesting product to continue to watch and to see how it matures and evolves over the next 5 to 10 years. But I think it's got a lot of legs. And multifamily in general, I think we're just undersupplied. So we're just, it's hard not to be bullish on, no pun intended, on, on multi in general.
Yeah, I agree. And I know a lot of our listeners all know this already, but when you're doing these build to rent neighborhoods, they are one tax parcel. You're not separating the parcels on these, right?
No, absolutely. Look, when we do BTR, we do single parcel. And it's for two reasons. One is, it does open a lot of financing for Fannie, Freddie, and HUD after the fact. They are purpose built to be rentals. They're not being built to potentially be sold or condoed or anything like that. And it also allows us to be more intentional about the actual site design of the property. Again, this gets back to purpose-built rental communities. And, we design everything with kind of this new urbanism flair to it, right? All the housing, all these cottages, they either They either enter from a landscape thoroughfare, treed and sidewalked thoroughfares, or their front door is onto a pocket park where they can actually walk out the front door. And with rental communities, you're trying to build exactly that. You're trying to build a sense of community, right? You want, I want people to walk out the front door, not go out the back door. I don't want somebody to pull in their garage after work, walk in the house and let their dog out the backyard and never walk out the front door and meet their neighbors. Because ultimately in rental properties, I want people to connect. Not only are they going to be happier if they make friends, but they're going to stay longer if they make friends. So we want them to walk out the front door. I want them to go walk around the sidewalk, walk down the street.
So typically have sidewalks then?
Sidewalks everywhere. Sidewalks around the pods, sidewalks up and down the thoroughfares. We want it to feel like a community and really encourage people to connect.
Yeah, that's awesome. And so on exit strategy, like you said, it's just you're exiting as a rental property. You don't expect that maybe down the road some of these would be sold to homeowners as condos or anything, right? Just don't expect it.
I don't expect it. It's I'm not saying it's not possible. You could put a condo regime like the old patio homes of the 80s, right? And people could buy the individual units, but I don't think that's the end game here. I guess it's a potential, but we're certainly not designing for that. Not that it doesn't happen, but that's not our model.
Yeah, well, it makes sense. Well, Chris, thanks for joining us. Great information. Thank you.
Great. Thanks for being here.
All right. And if you want more information, you can check out their website. It's middleburg.com. And if you have some sites around the Southeast or maybe around the country, you might want to share it with them. Hey, look, if you need anything around the country, let me know. We'll try to hook you up with the right contacts. My email's an easy one. It's michael@bullrealty.com. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at creshow.com. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.